Alright, guys, so let's talk about China and the big headline that's floating around. Once again, many believe it's the end of the Chinese economy. But the narrative of collapse is getting old. Digging into the story, we'll also realize China is becoming more self sufficient. It might be Western companies that are actually in trouble. Foreign investors pull record amounts of money from China. Overseas firms took away $15 billion from China in Q2. And at the same time, you have Chinese firms investing $71 billion overseas at the exact same period. Sure, the optics look really terrible. Money is leaving China from both local businesses and Western companies. But before we declare the end of Beijing, we need to look at this differently. The first factor of Western money leaving is the decoupling of the West and China. In other words, geopolitics drove a ton of capital out of China.
We're also united in our approach to the People's Republic of China. And the joint statement released yesterday outlines the shared principles we've all agreed at the G7 and beyond dealing with China. We're not looking to decouple from China. We're looking to de-risk and diversify our relationship with China. That means taking steps to diversify our supply chains, and we're not dependent on any one country for necessary products.
In today's economy, geopolitics is mixed heavily with economics. And when the US gives a directive to the risk from China, you can be sure that investors across the Western world they all pay attention. All the trade sanctions, restrictions, and tariffs, they all have one common theme. If you invest too heavily with the Chinese, you might get punished. It's not a coincidence that money into Beijing started to crater shortly after the Ukraine war started. The capital into China reached a record high of $107 billion before then. But after the conflict broke out, we have been seeing less and less investment money coming in. And in late 2023, money started to leave the country by the billions. The US tariffs on China are a perfect example. Earlier this year in May, President Biden he slapped Beijing with a 100% tariff on EVs made in China. It's not just targeted at Chinese brands like BYD or NIO. Tesla has a gigafactory in Shanghai, so cars rolling out of there are subjected to American import taxes as well. On a practical note, the US basically announced a penalty to global manufacturers. If you dare to build stuff in China, we'll cut away your access to the US consumer market. It might be EVs today, but it could be other products tomorrow. We have a long list of high value goods that could be at risk. Semiconductor punishments are coming in 2025 as well. Even chemicals or plastics could be next, and this is enough to terrify a ton of Western companies away. In June, the Biden White House drafted a plan to restrict investments into Chinese companies. And this means a ban on certain investments, especially in the fields of technology and AI. The US wants to ban everything from equity investments to debt financing and even joint ventures. The agenda is to stop money from entering China to build up critical sectors of their economy. Globalization is essentially done at this point, and for Western money, China is becoming a high risk destination because the US says so. They says that it is. But that's just one side of the coin. It's important to also consider another obvious fact. Western companies simply can't compete on Chinese soil. And there are so many examples we can give. And let's just pick a low-hanging fruit for this one. General Motors is the biggest automaker in the United States. Their market share is around 17%, but in China, the company is crashing hard. GM has been laying off staff in China, and they'll meet their local partner for a larger overhaul of the operations there. In other words, more layoffs are coming and more capital will be leaving. China used to be a gold mine for all the Western automakers, especially in the 90s till 2020. You had a rising middle class and not much local competition, but everything has changed. China's supply chain is so robust that the world built a ton of their factories and relocated expertise there. And now you have local brands like Great Wall Motors grabbing market share. In 2018, General Motors sold 4 million cars in China. It has dropped to 1.8 million vehicles sold. And this is during the same time when Chinese vehicle registrations shot through the roof. It's not the Chinese economy contracting, It's simply Western companies behind the eight ball. They didn't innovate fast enough. Brands like Volkswagen and GM didn't embrace electric vehicles enough when even the government was obviously pushing for it. They had a 2030 target of 40% of new sales being EVs. How big of a bad signal do you need? When we talk about China, we have to state the obvious. The Chinese consumer is still recovering. The property collapse probably isn't done yet, and consumption will continue to lackluster for quite a while. But make no mistake, the demand is still there. Retail sales grew by 2% in June. People in China, they are just more price conscious. They want more value for the same price, and that's simply human nature. Starbucks is a perfect example of this. Their China revenues tumbled by 11% in Q2. Same store sales dropped by 14% and transaction volumes dropped by 7% as well. Does that mean Chinese people are drinking less coffee? Not really. They are simply pivoting to local brands that offer more for less. Luckin Coffee, a local Chinese chain, is eating market share from Starbucks. Even in Singapore, they are popping up virtually everywhere. And it's really simple to order. They have an app where you can just order anywhere and they flood you with a ton of coupons. The prices are simply impossible to beat, at least for a Western company. Take a look at the prices here. Starbucks is at 33 RMB, while Luckin is at 11 for the same volume. Coty Coffee, which is another Chinese brand, charges only 10 RMB. It's impossible for Starbucks to compete, especially when everyone is doing cutbacks. The Chinese consumer isn't collapsing, they're simply evolving, they're getting smarter. China's middle class is still growing, so the potential for companies to expand is still tremendous. Luckin Coffee tells us all that we need to know. In 2023, the brand opened nearly 8,000 stores across the country, from Shenzhen to Shanghai to Beijing. In the first 5 months of this year, they opened over 3,000 stores. In contrast, Starbucks managed only 10% of that. Luckin Coffee cracked the code. They understood the local consumer, but Starbucks simply didn't. Will we continue to see investment capital from China leave? Most definitely. Companies that can't survive will pull out, and geopolitics will also prevent new entrants from coming in, at least for now. We mustn't forget about the rise of nationalism as well. What the West is doing is pushing Chinese consumers closer and closer towards local brands. There's a material impact of demonizing China and a relentless assault on Chinese industries. You just galvanize the youth to become consumer patriots and shop locally. The policy of containment will only hurt Western brands in China. It just doesn't make business sense. In 2020, McKinsey surveyed 5,000 consumers across 15 Chinese cities. 85% said they would buy a local brand over a foreign one. And that was before the crazy sanctions, especially the ones on Chinese EVs. As a Western CEO, you should be horrified your own government is pushing your customers towards the local Chinese competitors. And how does that help you with your bottom line? It doesn't. There's a big disconnect between the data and the underlying story, and this is where we need to investigate a little more. Chinese firms have sent $71 billion overseas in the second quarter of the year, and that's 80% more than the year before. So, why is China doing that? Before we answer that, here's an important chart to lay the groundwork. In 2000, the US was the biggest trading partner in the world, hands down. Fast forward 20 years, China is now the dominant player. They sell a lot of stuff to the world, which means they naturally want to expand their footprint. Companies invest overseas mainly for two reasons. The first is to tap on cheaper labor, and that's why the US corporations they went into China in the first place. The second is to access new markets and avoid tariffs. And that's why companies like BYD they are setting up shop in Hungary to avoid the EU tariffs. So China sending out investment to the world should be seen as a sign of strength. It's money leaving China, yes, but it's heading to build productive assets around the world. Chinese money entering the world is a good thing. It provides jobs, it provides the flow of technology and critical expertise in.
20 évvel ezelőtt nem lehetett Magyarországon legfeljebb nagyítóval találni kínai beruházást. Ma pedig azt mondom, hogy tavaly az összes Magyarországra érkező beruházás 3/4 érkezett Kínából, és jelen pillanatban 6400 milliárd forintnyi kínai beruházás zajlik Magyarország területén. Az önök befektetései, mélyen tisztelt elnök úr, emberek tízezreinek adnak munkát, biztonságos és kiszámítható megélhetést. Ezekért a beruházásokért persze mi versenyzünk, hiszen a kínai vállalatok versenyben döntik el, hogy hol valósítják meg a beruházásaikat, és mi magyarok büszkék vagyunk arra.
Huge amounts of money from China is a sign of strength. While the US military expands like crazy, China is expanding their trade with the world. America values military strength, China values economic strength. Gloating over China's supposed demise isn't a winning strategy. What the West should be concerned about is how to deploy their capital better. China recorded an incredible 250 billion trade surplus in Q2 this year. And this is money the Chinese government can use to subsidize their industries. Instead of buying US Treasury bonds, China is rolling the profits back into their economy. They are building out incredible industrial capacity and they are taking over everything from shipping to EVs. FDIs account for only 3% of total investment in China. Even if all the FDIs drain away, the enormous trading profits allows Beijing to throw money at the problem. But here's the crazy part. Eventually, Western FDIs will come back to China. Despite the narrative of decoupling and China being the boogeyman, all that will have an epic U-turn. Ignoring the Chinese market is simply impossible. By 2030, the rising middle class will surge higher. High-income people earning more than 340,000 RMB will hit 20% of urban consumption. And the upper middle class will account for 60% of consumers. And that's people earning up to 50,000 US dollars, which is a lot of money in China. If the Nikes, the Starbucks, and the McDonald's of the world want to expand, they have to do it in China. If Volkswagen wants to sell more cars, they also need the Chinese consumer. The only way to compete with local brands is to build factories and stores on the mainland itself. There's no other way. The FDI situation will eventually turn, it's just a matter of time. So it's critical we have an objective view here. Yes, the Chinese economy hasn't fully recovered yet. The property collapse did a number on it. But compared to Western economies, it's actually doing fantastic. Industrial production for July grew by 5.1%. In the US, it is just 0.6%. Retail sales in China grew by 2.7%, but in the US, it is up by only 0.9% in the same period. Making comparisons is very important. The Chinese economy is doing fine. The West and Wall Street, they want China to save the world, and that's why they are making so much noise. They want Chinese money to buy their products. If China drops below 5% of GDP, it's the end of the world. But if the US goes below 1%, it's called resilient or modest growth. And even if Beijing decides to launch the stimulus boats, I don't think Western companies will benefit. The money will circulate within China and consumers will buy from local brands instead. And that's what happens when you keep hammering a country with sanctions plus an endless trade war. Money is leaving China, yes, but not for the reasons the mainstream media is saying. But let me know what you think. Can Western companies survive in China? Does the Chinese economy even need outside investment? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.